Hello, and welcome to the Q2 2016 results presentation for BioSyent Inc. My name is Rene Gorham, and I'm the Chairman, President, and CEO of BioSyent. I'm going to start today's presentation with a recap of our sales performance for the quarter, and I'll follow that with a 6-month period. So for the 3 months ended June 30th, our sales reached just under $4.4 million, which was an increase of 22% from the year-ago quarter. Our EBITDA was $1.4 million, up 19% from the year-ago quarter, and our net income after tax, NIAT, was a little over $1 million for also a 19% increase versus the year-ago period. For the 6 months, the first half of the year, sales reached just over $8.1 million, an increase of 18% versus year ago. EBITDA of $2.66 million, up 7%, and NIAT up 8% at just under $2 million. So clearly you can see that the second quarter growth accelerated in the business, and I'm going to tell you a little bit more about what's going on. So the drivers in the business, so total pharma sales were up 20% in the quarter versus 2015. That's in contrast to plus 15% for the entire 6-month period ending June 30th. In the Canadian pharmaceutical business, sales reached $3.75 million, which was a record quarter and represented a 17% increase over a year ago. And over the first 6 months of the year, we were up 11% versus 2015. So driving that was FeraMAX. Sales of FeraMAX in Canada were up 15% in the second quarter. The Aguettant system, it's a little bit of an eye-popping percentage, but it is mathematically correct. Aguettant system, of course, relaunched at the end of the first quarter this year. Adoption is progressing in hospitals across Canada. The year-ago period is a very low base for comparison, so up 388% for the quarter. Don't expect that kind of percent increase to persist, but we will be working off a low base, or in fact, in the second half of the year last year, no base, as we report results on the Aguettant system atropine. And Repagyne sales were up 96% in the quarter and 116% in the first half versus the year-ago comparable periods. Although those numbers might indicate a deceleration of growth, the one thing to keep in mind is that the year-ago Q1 were fairly small numbers, so we're working off a small base. I think the business has continued to progress. Nevertheless, the 96% Q2 results over a year ago is something that we're pleased with. Our business outside of Canada with FeraMAX has continued to progress. In the second quarter, our sales more than doubled, and we've now recorded sales of FeraMAX outside of Canada in 6 consecutive quarters. We also measured over the first 6-month period, sales also more than doubled versus the first half of 2015. That business continues to progress, and we see it tracking to a greater than 50% growth for the year. Our legacy business has been performing well, and just a couple of numbers to share with you and just caution you not to kind of expect that business to continue to progress at this pace. Some of it is early orders from customers, but in the second quarter, sales were up 41% versus a year ago, and for the first half, we're up 76%. Most of that is driven off of our Canadian protected sales, although in the U.S. we are ahead of plan, but below the year-ago period, I think, is what we expect for the year. This is highly dependent on external factors, this business, and we are focused on our pharmaceutical products and growing our pharma business. From time to time, we get pleasant surprises what happens with the legacy business. So in the quarter, some key highlights. So as you'll recall, we signed an exclusive Canadian distribution agreement with a new European partner for 2 innovative cardiovascular products. We estimate that in combination, those 2 products will represent peak penetration sales of about $20 million. We're going through the process now to get those products ready for filing with Health Canada, and of course won't launch those products until after Health Canada has approved them. Cysview blue light cystoscopy has been recommended by the Canadian Urological Association at their national conference in June. It was one of the featured items at the beginning of the conference. It also has been adopted as a standard of care by the American Urological Association. So this is really corroboration of what we saw, the potential in this product and the opportunity for us here in Canada. Cysview has now been evaluated by several Canadian hospitals. It's been used in patient procedures for the first time in Canada, and our commercialization is progressing, though I candidly would say, below the curve of what we had expected. The numbers that you see presented to you today include very little in terms of revenue contribution from Cysview, other than wanting it to contribute a little bit more as a positive, in that as the business progresses, that will continue to drive growth overall for our top line. In the quarter, we also established and operationalized a new wholly owned subsidiary that is known as BioSyent Pharma International, located in Barbados, and the purpose of that business unit is to facilitate the expansion of our international business. We continued to improve the availability of RepaGyn to Canadian patients. In the quarter, more than 500 Canadian pharmacies purchased RepaGyn for the first time. That is a similar figure to what we have seen over the last several quarters. So that availability is growing, and over time that means that our marketing and sales activities will then be supported with better product availability across the country. Our sales force continues to promote the FeraMAX #1 marketing campaign. We went live with that in the second quarter. We have also some direct to doctor and direct to pharmacist and direct to patient communication that's supporting that. And just a reminder there, FeraMAX has been named by Rogers Healthcare as the #1 doctor and the #1 pharmacist recommended over-the-counter iron supplement brand in Canada, with over 30% of each of those healthcare professional group recommending FeraMAX. Also, with respect to FeraMAX, we continue the national conversion of the FeraMAX product to vegan certified. We started that in the first quarter of the year. That has continued to progress. Based on the current rate of sales, we will have fully converted our business to vegan certified by the end of the third quarter of this year. That's not a major driver business for us. It is certainly a differentiator versus our competition in that it's vegan certified, but it also provides ease of patient selection for the healthcare professional, for the doctor that's committed to FeraMAX, and just makes it easier for them to select the right patient for FeraMAX. Looking back at the last 20 quarters of pharmaceutical sales by quarter, you can see there that Q2 reached just over $4 million. On this chart, you see the split between domestic and international sales. And as I mentioned before, you see that we've delivered 6 consecutive quarters of sales of FeraMAX to international customers, and in fact, 7 of the last 8 quarters. So that business continues to gain traction and gets a little bit more consistent in our business. So now looking forward, as we kind of go into the balance of the year of 2016 and into 2017, 2018, what's going to be the driver of revenue growth for the company? So we see growth, still some more growth from our existing product portfolio, being FeraMAX, the FeraMAX products to existing international customers, and indeed RepaGyn and Cathogel. Of course, we have a number of new products, some of which have not yet contributed. Some of them are modestly contributing to our top line results for the first 6 months this year, namely Cysview, the Aguettant System Atropine. We announced in May that we got Aguettant System Phenylephrine approved. That product is in the production queue, and we expect to start shipping early in November. So we should see some modest contribution in Q4, and then building from there into 2017 from the phenylephrine molecule. And of course, we have an additional Aguettant System product in the Health Canada review process. So in addition to that, we got a number of new or additional FeraMAX international markets that are signed but have not yet started contributing to our international sales, and we expect growth there. And of course, importantly, in terms of total dollar potential, the 2 new cardiovascular products that I've mentioned a couple slides ago upon Health Canada approval. So we see no contribution in 16 or 17, likely not from those two products. In aggregate, that portfolio of products that I've just walked through and those opportunities in Canada and internationally, we see as having peak penetration value in the high 50 million. So just a shade under 60 million is our assessment of the peak penetration value of that portfolio of products. Our work on our deal funnel and in licensing new products is not something that ever ends. It's ongoing. We have, I will call it, a few projects that are kind of moving through the process nicely. We expect to be announcing further in licensing deals by the end of this year. Taking a quick look at our operating expenses, you'll recall in the first quarter our OPEX grew significantly faster than the top line. This was really a recognition that we needed to add to our human resource complement to support the growth of the business and to get out in front of coming growth. We had a 37% OPEX growth versus the year ago period in Q1. You see here on this chart that in the second quarter we had an OPEX growth versus year ago of 25%. That rate of growth has come down significantly for a total 6-month blended number at 30% growth. And as you'll recall, that compares to top line growth 18% in total for the first 6 months. But for the quarter itself, top line grew 22% and OPEX up 25%. You'll know if you've been a frequent listener to this presentation or following along in our MD&A that we had a significant increase in our human resource, essentially starting late Q2 of last year into Q3 and 4 and Q1 of this year. We see no further additions to our headcount, certainly nothing planned in the second half of this year, and some normalization of the change in OPEX. Quick look at a balance sheet snapshot. I guess the key figures are that our working capital is up 18% from the closing balance sheet for fiscal 2015, so December 31st, 2015. As of June 30th, we had cash and short-term investments of just under $10.5 million. That represented 8% growth from December 31 of 2015, and we continue to be debt-free. Our return on equity for the 12 months ending June 30th was 32%. You see in this chart that those figures are coming down from extreme performance in the 2011 through 2014 period. Obviously, this is somewhat reflective of our strengthening balance sheet, but we are working hard on opportunities to continue to reinvest in growing our business. We're not unhappy with a 32% return on equity, and I imagine most seasoned investors wouldn't be. On a diluted earnings per share basis, in the second quarter, we earned 7 cents. That compared favorably with a year ago. On a rolling 12-month basis, so 12 months ending June 30th, we earned 27 cents fully diluted, and that was up from 25% in the comparable period for growth of 8%. Just a reminder, we've got a fairly clean cap structure, just over 14 million shares outstanding, another 546,000 share options for fully diluted of 14 million, a little over 14.6 million shares fully diluted. And I wanted to thank you for your continued interest in our company, following our progress, and welcome you to do some further research, either through our corporate website, through our public disclosure at cedar.com. I find TMX Money also quite accurate and up to date in terms of financial metrics, and of course we have product and marketing websites available as well. So once again, thanks for your interest, and we look forward in the coming months and quarters in reporting our continued progress in our business.